Thank you guys all for joining us today. I want to introduce to you Danny Randazzo. Danny Randazzo, I'll have you go ahead and start off by giving us a little bit of a background about your experience in real estate and some more of your background as well as in the multifamily space.
Yeah, thank you, Dan, for having me on, and I'm happy to be in touch with the Multifamily Investor Nation. A little bit about my background. I got started in investing in 2013. I bought a single-family house out in the San Francisco Bay Area, rented out some bedrooms, and really house-hacked my way to build an equity nest egg. Over the course of time, I had a couple of life transitions. I met my wife and we decided to move across the country to Charleston, South Carolina and start a real estate portfolio. Once we made that jump and kind of sold everything off in California, we really looked for investments with the opportunity to scale and have a viable portfolio that can generate income streams for us. And so I kind of dabbled in a variety of asset classes in one single market in Charleston. And the reason for that is we really liked the Charleston market. We knew it well and we had a team there. And investing in a variety of asset classes gave me the opportunity to educate myself on how to, number one, close deals, how to work with property managers, how to work with insurance companies and other vendors that support you in your role as a property owner. And then we built that business and we've done exceptionally well in that, but it was on a smaller scale. So about 6 months ago, we really came into this aha moment of transitioning our focus from a variety of asset classes, including commercial and multifamily and even some single families, into strictly multifamily. And why it's so important for the multifamily investor nation, we're all here because we like to invest in multifamily properties, but the real important things that we see in multifamily is the scalability, the control and ability to affect the property valuation from an owner asset manager standpoint, and the ability to scale and control your expenses. So you've got the ability to push your income if you're doing value add, and you have the ability to control some of your expenses and really have economies of scale versus one single family house that you're never going to get any real pricing discounts or advantages to that. So that being said, really focused on multifamily. I've got a background in financial consulting for multi-billion-dollar companies and advising them on how they can improve their financial operations. So my nature as well, I'm a spreadsheet guy. I love the numbers and everything that they bring to the deal. So initially to qualify the deal, how do we do that? To underwriting, analyzing, and then also keeping things conservative and what to look out for when you may be looking at someone else's numbers or a broker pro forma.
Well, I'm very glad that you like to be inside of spreadsheets, because I do not like to be in spreadsheets as much. So I like to be able to look at the finished product and kind of see what's been put together, and kind of, giving our audience a little bit of a background is, Danny and I now are partners in our deals moving forward. And so I'm more on the investor relations side, and thankfully he's on the finance and underwriting side and does a phenomenal job with the spreadsheets and things like that and the stuff that I don't like to do. So we kind of balance each other out very well. And of course, we also have our third partner in our group, which is Brandon Abbott. He's the one that did the property tour video that we did last week. So for those of you who might have missed that, you can shoot me an email, dan@multifamilyinvestornation.com, and I can shoot you over a link to that so you can watch the replay if you did miss that, for the property tour video that we did last week on some different tips to look for and stuff like that. So Danny, I want us to get started with the underwriting strategies that we want to go over with today, and start off by talking about what are some things that you do when you quickly analyze a deal? Because obviously with the amount of deal flow that's coming through, we can't sit there and analyze do a full underwriting on every single one of the deals, but what are some things that you can do, or what are some of the strategies that you use to be able to quickly analyze a deal?
A couple of things off the bat. Number one, you need to be knowledgeable of your price per unit metric. Meaning, if you've got a property that is 10 units and it's being sold for, let me back up. If you've got a property that's 100 units, right? Because we're focused on things that are larger than 100, usually 150 or more. So a property, it's 100 units, you're going to sell it for $10 million. That is a breakdown of $100,000 per door. And in the markets that you're investing, you will know if $100,000 per door is expensive or if it seems to be a reasonable price or if it's a good deal. So understand price per unit. By the way, knowing this stat is going to earn you a lot of credibility with the brokers, because that's typically how deals are talked about in the multifamily space is what is this property trading at per door or per unit? So being able to qualify a deal, if you can ask the broker, hey, what do you think this is trading for? If they give you a total sale price, then just divide it by the number of units, come out with the price per unit, and then determine, if that fits for the type of property you're buying. For example, if it's a value add property and, newly renovated buildings have traded for $90,000 a door and you're going to buy for $70 a door and your plan is to invest $10,000 per door in upgrades, then your all-in price is $80K per door, and that seems to be a good deal. I'm not going to go into the market specifics, but from a quick quick analysis standpoint, know your price per unit and know what that is for your market to be able to compare things to. The second item that I do want to talk about is you need to have a way to quickly analyze the numbers for a deal to see if it even qualifies before you go into full underwriting due diligence. And the way that I do it, and Dan, I'd be happy to share our quick analyzer calculator. And if you want to give it away to anyone attending the Multifamily Investor Nation Summit in January, feel free to do that. But basically, what we do in this quick analyzer calculator is put in the potential purchase price that you're going to buy it at, and that also calculates your price per unit. You come up with your general loan terms, and again, why I said you need to have a team that supports you. You should have a lender who can give you a quick quote of, here's kind of the terms that we're looking at, and here's what we could do in terms of loan proceeds for this type of deal. And then you input your expenses from a very high level, just a rough number. You could take the seller's pro forma numbers, and then you just analyze what your basic return would be to see if it even qualifies. And I try to qualify a deal in about 5 minutes or less. And if things begin to check out and the boxes of, yes, this seems to be making sense. Yes, the price per unit works. Yes, our estimated rehab budget is going to work as well. Then we'll shift from the quick qualifying a deal into the full underwriting for a deal.
There we go. I had the mute button on there, so apologize for that. As I say, one of the things I want to talk about with the quick deal analyzer that you mentioned is what we're going to do is at the end of this webinar, I'm going to give a special promo code to be able to give $100 off of the Multifamily Investor Nation Summit that we're going to be doing in January. And for those that register after the webinar using this promo code, we will also give them the quick deal analyzer. So for those of you who are on here and have already registered for the webinar, not for the webinar, but for the summit, just shoot me an email, Dan@multifamilyinvestornation.com, and I'll give it to you as well. So I don't want to make anybody feel like they're being left out or anything like that. So I appreciate all of you who have already registered. We're inching up to a pretty high number right now. Our goal is to get to 1,000 attendees. So we'd love for you to be able to spread the word on it as much as you can for us. We're going to have, right now we have 29 confirmed speakers for that event in January. We have another 17 that we have feelers out for. So hopefully by the end of this week, we'll be, finished up, seeking some of the speakers and panels for our event. And we'll have a little over 40 people, I believe, that will be speaking at this event. So it's an event that you don't want to miss. It is virtual. We're also putting together some watch parties across the country where you can also be able to network with other people in this multifamily space, but not have to travel as far. So make sure you go to the MFIN Summit, MFIN for Multifamily Investor Nation Summit, MFINSummit.com. You can see right here above me is the domain name. And just go there and use the promo code. I'll give that promo code to you at the end of this webinar. So make sure that you do that, and you'll also give you the quick deal analyzer if you use that promo code. So we'll be specific to today's webinar. So the next topic that I want to go over is some of the basic underwriting that you usually will go through when you're trying to do some of the underwriting, some of the underwriting basics, if you will.
Absolutely. And what I want everyone to do is pull out a pen and a piece of paper or get your Excel pulled up. And I want to run through the critical expenses to a property because, again, you're going to know and your team will know kind of what the rent premiums are, and you can mystery shop and use apartments.com to get what your rent premiums are. But a critical component to the underwriting is ensuring that the trailing 12 expenses make sense based on what the typical average expense should be. And again, these come down to price per unit. So that way we're comparing apples to apples. And typically these unit sizes are, again, 100 or more. So if your deal is a little bit smaller than that, these price per units in terms of expenses may be a little bit different, but certainly if you're above 100 units, these will make sense. So let's get the pencils ready and or get your Excel sheet out to take a couple of notes, and we're going to run through expenses, and I'm going to give you what the typical average expense per unit should be. So the first one that I want to cover is payroll. And payroll, yes, is separate than your property management fee. Payroll is the fee that is paid for the on-site staff working at the property. And then, of course, any of the government fees or taxes or healthcare fees that go into paying employees of that property. And payroll, again, for 100 unit or more properties, typically ranges from about $1,000 to $1,200 per unit. So again, it's $1,000 to $1,200 per unit is your typical payroll expense on average. The next one is maintenance and repairs. So this again really talks about what are the typical on average maintenance and repair requests over the last 12 months. And the typical rate is about $250 to $350 per unit. That's your norm. So when you're looking at your underwriting and you're looking at the seller's pro forma, you're going to want to determine what their maintenance and repair price per unit is. And if they're really high, if they're above $350, that might be an area that you could reduce in the future by having some operational efficiencies or a better handle around R&M or repair and maintenance. If the seller's pro forma is below 250, you should watch out for this because they may be allocating part of their T12 expenses to a CapEx line, and we'll cover that. But basically the CapEx line means non-recurring repairs. So for example, if you replace the roof, that would be considered a CapEx expense because you're not typically going to repair a roof every year, and it really wouldn't count towards your typical operational T12. The next item, so we've covered payroll.
Real quick here, I had a quick question that came in through here just as a clarification. That's the per unit expense per year, correct?
Correct. Annually per unit. So payroll annually should be about $1,000 to $1,200 per unit for the entire year. Maintenance and repair, $250 to $300 per unit annually. The next item, contract services. So these are your vendors like lawn maintenance, or if you're in the north, snow removal, fertilizing. If you're in the southeast, you're going to have quarterly pest control. So any contract services, your trash, things like that. These expenses should typically be about $200 to $400 per unit annually. Next item, turn/make ready. These are your typical move out and turn units. So kind of paint, carpet, flooring, just the touch-ups to get your unit rent ready. This cost should typically be about $150 to $300 per unit. And, you know, put a star next to this one, because as you are envisioning your future property and what your strategy is when you buy it and close on it, you might be able to reduce this expense if you're doing a heavy value add up front. The next item for the property is advertising. This really covers any sort of marketing to get your units rented out that the property management team may implement. The typical cost is about $100 to $200 per unit annually. Next expense item is your administration fees, and these are things like banking. I'm thinking about other administration fees, any sort of like collection items, or whatever it takes to kind of run the back office of the business. And this expense should typically be about $150 to $250 per unit. Utilities is the next expense item. They typically run about $750 to $900 per unit on an annual basis. And again, this item is going to really be dependent on your area and your market specifically. You may have some sort of RUBS or utility reimbursement that comes in from an other expense line item, but you're still going to want to see in your T12 the actual utilities, your actual gas, electric, and water for that property. And they should be, like I said, averaging about $750 to $900 per unit. So if you're higher than that, you may look to optimize or get energy efficient items for the property to reduce that expense and ultimately increase your NOI and increase your property value. Next expense item is your property management fee. We won't really go into this one, but typically for large multifamily properties, you'll be paying somewhere between 3 and 5% for your third-party professional property management.
Now, one thing that to mention here too is that with that fee, it seems a lot lower than you might be used to if you're into the smaller, multifamily space, whether it be duplex or 20, 30, 40 units, because these larger properties typically have on-site property management. And so that's why those fees are usually a little bit lower, because you're going to be paying for the payroll, like you mentioned, the payroll expenses for each one of those on-site people. Then you'll also be paying for this percentage for property management as well.
That's a great point, Dan. Thank you. So if you do want to look at a holistic kind of property management cost, you would need to account for your payroll expense plus your PM fee. The next expense item, taxes. So, this one, go to your county assessor website, and you can get a calculated amount with a future purchase price. So always be sure to check the county assessor's website to make sure that, when you buy the property in the future, is that going to change? And it will likely increase your real estate taxes for that property. Most assessor websites are very good and have a little calculator that you can use. Next expense item is around insurance. Typically, insurance, again, it's going to vary based on location and type of environment that the property is in, but the typical minimum insurance cost for a property is about $225 to $250 per unit. So again, I would say on this item, get multiple quotes from multiple vendors, and you can make your decision there. But from a pro forma perspective, plan for about $250 or $225 a unit annually for insurance. The next expense item is going to be your lender reserves requirements. Typically, it's $250 per unit. That's just kind of on average across the board for most of your multifamily lenders. Next expense item is asset management fee. So this is the fee that you, as the syndicator, or if you are a passive investor, this is a very common fee that the general partner or deal syndicator would charge to oversee the function of the property and the execution of the business plan for that property. And the typical fee on this is somewhere between 2 to 4%. Most of the deals today are around 2 to 3, but again, this one really varies on the type of business plan for the property. If it's a deep value add and there's a lot of work to be done, the fee may be a little bit more. Or if it is, more of a buy and hold and, cash flowing property from day one, the fee may be a little bit less. But again, it just depends. 2 to 4% is pretty normal or typical. The last item is an other expense bucket. So this is really the last expense that you would have. I don't really have an average for it, but as you think about any additional items for the property, you would just bucket them into that. So for example, if you knew that your property required some additional type of road maintenance on an annual basis, or special lighting, or some sort of solar or energy efficient item, you could always bucket something in the other expense bucket. So I'm going to run through the expenses just back to back, and we'll kind of recap everything. I'm not going to go through the average prices or cost per unit again, but a list of the expenses, and here we go. First one, payroll. Next, maintenance and repair. Next is contract services. Next is make ready or turn. Next is advertising. Then you have admin. Then you have utilities. You have the property management fee. You have your real estate taxes. You have insurance. You have the lender reserves. You have an asset manager fee. And then you have your other expense bucket. And that's a good summary of the types of expenses that you're going to need to analyze in your underwriting.
So a couple of questions before we move on to the next topic here. I got inundated with several questions. So I'm going to go through a couple of them. Some of them I was able to answer because there are some other questions that I could answer. And some of these I can answer as well. But I thought it might be helpful because I think other people might be asking some of these same questions. So first one that I got a couple of questions about was about when you're figuring payroll expenses, does that also include the health insurance expense for those employees?
Yes, it should. It would be a part of that kind of $1,000 to $1,200 per unit annual cost.
So that would be included. And then one of the other questions here was, what is the cost to actually turn around a unit?
The average cost, and again, you're going to have some units that are in worse condition and some that don't require anything. So the average cost to turn a unit is about $150 to $300 per unit annually.
And that's what the basic turn, no renovations, just the cost to be able to clean and turn it to the next tenant.
Yeah, maybe you're doing some flooring in one and some paint, but on average, you're doing about $150 to $300 per unit on an annual basis.
What is one of the questions on comments on here was that the insurance seems a little bit low at $250 per door. What are you seeing?
Again, insurance is going to vary drastically. In Charleston, South Carolina, you may have a significant flood insurance cost, and the $250 per unit is nowhere close. So without spending too much time debating the insurance, that's why I suggested, get a quote from 3 or 4 different providers and really figure out where you're coming in at. But on average, across the country, about $250 per unit annually.
Next question is will the utilities be more than $750 to $900 per unit if the property is a little bit older?
Absolutely, they can be. And again, why I wanted to share these averages is for the multifamily investor nation to be knowledgeable of what the typical is. And if you fall outside of the typical range, either way higher or way lower, do some due diligence to figure out why that is. And it can certainly be explainable. So going back to our insurance example, if you're in the Southeast and you have to pay flood insurance, it makes sense that your cost is going to be greater than $250 a unit. The same goes for utilities. If you have an old building with single pane windows, absolutely your utility cost could be way more than $900 per unit. But again, just your averages is where you kind of want to fall. So if you deviate anywhere above or below, research and understand why.
So I'm going to just take a quick break, not break, but quick, time here to, for those of you who are joining us on the Zoom platform, obviously there's a box there that says Q&A. You can add any questions that you have there. If you're on our Facebook platform watching it live there, you can ask your questions inside of the box there. We'll try to get to as many of these questions as possible today. And if for some reason we can't get to your questions, you can always shoot us an email. You can email Danny. Can I give out your email, Danny?
Go for it.
Sure. It's Dan at randazzocapital.com, and that's Dan at RANDAZZO capital.com. And for those of you who are on Facebook with us, show us a little bit of love, hit the like button, share it with your friends, and comment, and just show us and let us know that you're there. Be very helpful. We have over 60 people right now joining us on the Zoom platform, and I know we have several dozen that are on us on the Facebook platform that are coming in and out. So thank you guys all for joining us. So going back to some of these questions, I'm getting several questions about, you mentioned property management fees and asset management fees. What are those a percentage of?
Yeah. The property management fee, again, I'm just going to give a quick definition. This is really to pay your property manager who is overseeing the property on a daily basis. Your asset management fee is for the general partner or the deal sponsor to manage the business plan and make sure that the property is performing to the metrics outlined in the investment opportunity. So they're checking in on the property and making sure the managers and the on-site staff are executing the business plan and getting the rent premiums that are required and to hit the business plan and hit the return. So those two fees, the property management fee and the asset management fee, are based on gross rent collected per month.
Next question here is about the advertising budget. Can you mention what that per unit, per year cost is again?
The advertising budget is about $100 to $200 per unit. And The other component with advertising is there's so much free advertising available out there. You really want to work with your property manager to understand what their scope is and what, additional advertising may be required. But you definitely want to have an advertising budget allocated so that way you can be first on those apartments.com lists, or even promoting within Facebook in your geographical area. You want to have about $100 to $200 per unit for advertising to make sure that you can get the highest rent premium available.
And the next question on here is about legal fees. Where would the legal fees go?
So legal fees, I kind of bucket into our admin line, our administrative costs. You can certainly break those out, but legal, again, it's part of the administration for what we look at. And it's, again, about $150 to $200 per unit. And let me caveat here, I'm not an attorney. I don't play one on the internet. Determine with your property manager what the eviction fees are, and if in your county you as a either the property manager or someone from the management company that can handle evictions, and that may help your legal costs come down. That way you're not paying for an attorney. But again, state specific, geography specific. So again, legal is bucketed in with our administration fee, of which is about $150 to $250 per unit annually.
So if you guys saw that little flash there, that was my automatic energy saving lights that went off because they didn't see me moving. So it almost affected my green screen back here. You guys get to see the green board on the back of my wall there. So glad you guys got to see that little flash there. So a couple other questions that are coming in here is about, well, for one, would you mind if we send out a list of each one of these expenses to everybody after they were, those that joined us on the webinar? Would you be able to do that?
We could do that.
Okay. So I will send out a link to those who register for the webinar. I'll send you out a link to be able to get the download or whatever file we create for this so that you can have it, because I know several of you are asking questions about, can you mention this one again? Can you mention that one again? So I had to step away and go handle something and came back and I missed something. So we'll definitely send that out to you once we send out the replay link as well. And for those of you who are watching this that might not have watched it live, you can send me an email at dan@multifamilyinvestornation.com, and I will also give you that list as well. So feel free to do that. Next question is about total expenses seem to be around approximately $4,000 per unit per year. What does that imply for the rents per unit?
What was the last part of the question? What does it imply?
For the rents per unit, the really what you're going to charge for rent for that unit. I think that's going to be a market, specific question, so it's kind of hard to answer that. But
it is, and typically your expenses from an overall high level standpoint should be somewhere between 40 and 50% of your gross income, and that is one way to kind of compare it. So very hard to answer what that looks like per unit. But again, your total expenses should fall somewhere between 40 and 50, maybe 55%, depending on the type of property, again, and where you're at, of your gross income. So your total collected rents, about 40 to 55% should be your expenses.
And this next question is kind of going around those same lines about, will you be able to talk to the property manager or the broker to be able to have that average dollar amount per door in that market for either expenses or, the actual market rents?
Yeah, a good property manager, again, a vital part of the team is having a relationship with the broker and the manager. A good property manager should say, hey, we've got a similar size property around the corner. Here's where we run in terms of cost per unit and in terms of rent premium for or rental rate per 1 or 2 or 3 bedroom unit type. And so they should give you a general idea of where things are at.
And I think another thing too is when you're asking brokers or you're asking property management companies, hey, what are these general numbers for this market? Make sure that they match. Like, are they actually the same, or is maybe the broker puffing them up or lowering them down to make the deal look better than it really is? And always balancing that out with various opinions from property management companies. I think that's all part of that due diligence process before you put an offer into a deal too.
Yeah, and that's critical. That really leads me to one of the most important parts of underwriting, and it's being conservative, because you don't want to go out and say, we're going to get way high income or rent premiums, and we're going to push way down our expenses, and we're going to generate all this value. And you pitch it to investors, and then you don't hit that high income number, and your expenses, you don't push them down all the way. And now your returns are nowhere near what you talked about. So having an understanding of the price per unit type that you're going to rent at, and then having a good grasp on the cost per unit for all of these expense items is going to make you very knowledgeable within the space to understand where a broker's pro forma is overestimating income or underestimating expenses, or where the seller may have pushed the repairs and maintenance super low to their CapEx expense has been really, really high. So it's going to give you that opportunity to see where numbers don't make sense, where you need to spend more time analyzing and really vetting the deal and doing your detailed underwriting to come away with a really conservative and deal that you feel extremely confident about, and knowing the numbers inside and out is one of those pieces.
So I think that because of the amount of time that we're spending on these first two things, that would you be open to doing another kind of like a part 2 next week to kind of finish up the last two things? I know there's a couple other questions that we have on this. Would you be open to doing that?
Absolutely.
Sure. So let's hold off. Next week, we'll do another webinar on what to look for in the underwriting that might be out of place, and what are things that you really need to make sure you're keeping an eye on before you put an offer on something, as well as answering the question of really what is that IRR, that internal rate of return. How is it related to the ROI and the cash on cash, and why is that a very important metric to look at? So we'll talk about that next week on the webinar, and I will send out right after this a link for you guys to register for that webinar as well for next week. So sometimes that happens. Sometimes we try to load it up with a bunch of different topics, and we end up not being able to cover it. So I have a couple more questions though still here to answer, but I will say that I told you guys that I would give you a promo code to register for the Multifamily Investor Nation Summit and get $100 off for watching the webinar today. So if you right now, after the webinar, go to MFIN Summit, that's Multifamily Investor Nation, just MFINsummit.com. You go to the website there and type in the promo code Danny. Of course, all letters together. No, it doesn't matter if it's upper or lowercase, but Danny, DANNY. Right now, you will be able to get $100 off of your ticket to be able to join us for the Multifamily Investor Nation Summit, which is a virtual online summit coming up in January. Over 40 speakers. Looking forward to having you there. So I've said my little promo. I'm going to type it in here into the little chat box for the Zoom. I'm not going to post it on Facebook, so I'm not sure how long I'll keep it out there. But if you're on right now, you've been thinking about it, you're on the fence, just do it. You're going to learn so much. Obviously, with these webinars, you're learning quite a bit as well up into that event. But if you go to the Multifamily Investor Nation Summit page, mfinsummit.com, type in Danny, you'll get $100 off just for watching the webinar today. So thank you, Danny, so much for providing that valuable information. A couple of questions. There's two questions here that really kind of coincide together. So I want to bring those to the table here for you to answer them. The question, I'll read both of them to you, and you can kind of answer them the best way you feel is necessary. So the first question is, how do you quickly analyze a deal that you do not have the list price or the actual offering memorandum from the broker says to be determined by the market? And then if you're in an area that doesn't have a comps per door, is there a way to calculate that value per door? So I think kind of both of those questions kind of coincide or kind of are interrelated a little bit. So I thought I might ask you both of those at the same time.
Yeah, I'll tackle the first question about how do you calculate the price to be determined by market. Brokers love this. However, more often than not, if you read every word of that pro forma or the offering memorandum, there's going to be some fact in there about what the market is trading at per unit. And that's where you do your basic math. You do your number of units times that price, and you come up with what the market quote unquote list price would be for that property. So what I would suggest is in that OM, the offering memorandum, or in the pro forma that they send over, look for the sale price per unit from previous comps, or look at a cap rate that's for the market. And again, you can do your net operating income from the T12 divided by that cap rate to come up with your list price. And then once you have your list price, you just divide it by your units to get a price per unit. So I hope that answers that first question. And then the second question was really around, and I'm drawing a blank, Dan, help me out. The second question.
Sure. So if you're in an area that doesn't have sales comps per door, is there a way to calculate that value per door? And I think, this question is really coming from maybe a little bit of a misunderstanding or confusion on how you actually calculate that per door cost. And maybe not, I might be reading it wrong, but I think that I'll let you answer it, because I know you know how to answer that question, but I think that there's a couple of different ways that we can answer that question.
Yeah. What you could do if there's information that's not readily available, first I would suggest ask a broker, either the sales broker, or if you have a broker, again, someone on your team, have a relationship with them, they should be able to pull a CoStar report and get you in some geographical mix, some market comps that have recently sold. And again, you just do the sale price divided by the units to get your price per unit. And again, doing that is not going to be a immediate answer or give you the proper guidance on making a good offer or not, because you're going to have to do a little bit more due diligence to say, if this person bought a property at $50,000 per door, but it required an extensive renovation where maybe they put in $15,000 per unit, that's one story. Or maybe there was a brand new, Class A apartment that just went in up the road at $90,000 a unit. So again, you're going to have to do your comps like you normally would. But to get that number one, I would get information from a broker, either that or that's the sales broker. And again, do your own homework. Number two, if those aren't readily available, I would look for comparable properties, and then I would go to the county website and I would determine when those properties were sold or traded, because it's all public information of who paid what when. And I would find my own comps. And, I know that's not a great answer to say, here's the website you go to get it, and you can get it in 1 second. But again, if I'm presenting a deal to investors, I want to have all of that information at my fingertips and know it intimately well so I can be knowledgeable of the market, of the deal, and of the opportunity. So, do your homework. The information is out there. Look on the county website, find the address for that property, divide the number, the sale price by the number of units, and you come up with that price per unit.
Great. One clarification, I just got a message from somebody. Got several of you that have already signed up and used the promo code. Thank you guys so much for joining. I know you're gonna get amazing value from this event. I will also tell you that I would give a 100% money back guarantee for this event. So you register for this event and you don't like it for any reason, let me know. I'll give you a 100% refund. That's how confident I am that you're going to enjoy this event. So go to mfinsummit.com, register for the event, and use promo code Danny. And because you're on this webinar and you get the $100 off, Danny also has offered to give you the quick deal analyzer that he has that will email to you if you use that promo code. So keep that in mind, that we will also do that for you as well. So thank you for that answer on those questions there. The next question is when working with a local owner, how can we get a copy of the expenses? There you go. Did you get it?
I may have been the culprit of that feedback. I apologize, everyone.
That was probably my loud voice is what it was. I was just projecting a little too far, so I apologize for that.
The question was, how do you get a copy of the expenses?
Yeah, how do you, when you're working with a local owner, how do you get a copy of the expenses? And I think, a lot of times with these larger 100 plus units, they usually have a lot better bookkeeping skills and bookkeeping people because the property management companies are the ones who are doing that. But, some of the smaller multifamilies, you get some of these smaller mom and pop owners and they really have a hard time keeping together these expenses. And that's why it's sometimes hard to do it outside of maybe doing some seller financing or something because you can't get debt on it.
Yeah. Any viable agency lender that's going through Freddie Mac or Fannie Mae is going to require a solid T12 or historical profit and loss statement in order to do their underwriting to qualify your property for a loan or debt terms. And when a property is listed with a seller and they're the owner, you need to work with them because ultimately it's in their best interest to have good financials, and the sale price would reflect a higher number if they have solid financials that you can really evaluate and determine, what price you're willing to pay for the income that it generates. However, if there is a opportunity that presents itself and the seller can't come up with any numbers, or the numbers they come up with just don't make sense, this is where you use the averages that we talked about and you come up with your own numbers. And again, be very conservative here, but come up with a purchase price that reflects the unknown of their trailing 12 expenses. And, like Dan said, maybe you pull in some seller financing to close the deal while you establish a solid, T12 in order to go to a bank or a national lender for long-term debt on the property. When those sellers and owners don't have good financials, I always think it's a great opportunity to buy. It's just going to take you a little bit more time to do your due diligence and even help them generate some numbers that could be used. So, more time, but sometimes a better deal.
So 2 last questions. So I'll cut it off with these last 2 questions. First one is about how do you apply future expenses to the units that may have already been renovated?
How do you apply future expenses to units that may have been renovated? If I understand the question correctly, the expenses that we talked about are still going to occur regardless if the unit has been renovated or not. So even if you renovate a unit today and in a year you want to sell it, you might have 150 to 350 in your repair and maintenance or your make ready cost. And that's just going to happen. So, I don't think you can reduce your expenses too much from these numbers if you have recently renovated.
Yeah, I was going to say, I think the best thing from an underwriting standpoint and a projection standpoint is to still use these same guidelines, whether they're renovated or not. Even though you probably, if they've already been renovated, there's going to probably be some sort of reduction in maybe some of the repairs and maintenance or whatever. But I think to leave these as standard guidelines is probably the better thing to do. And then you get year 2, 3 years into the project and you've had reduced expenses. It's just even better for you later on down the road with you and your investors.
Yeah, absolutely. I would never, want to take out repairs and maintenance because all of the units were just turned in the last month and, we don't budget or allocate that expense and we have it come up, then our returns are worse. So you would always want to be conservative, plan for those expenses. And when they don't happen, your returns just got better.
Yeah. Absolutely. Last question is actually a question from me that I think that might be a good question to maybe hold off until next week. So I'll kind of, we'll have 3 different things that we'll cover in the webinar next week. So we didn't get to cover everything today. So next week, we're going to cover what to look for in the underwriting. And then also what is the IRR, the internal rate of return, how that relates to cash on cash and how to calculate that IRR, because there is some varying opinions on what's the best way to calculate that, and we'll answer and debunk some of the questions and myths on that as well. And then the third thing, which is the question I have, is what do you do when you see some of these expenses out of balance, and how do you handle those and how do you adjust for those when you're underwriting in your future projections before you put an offer on something? So thank you, everybody. Thank you, Danny, for joining us. I really appreciate all of your insights and your time here. And thank you for being put on the spot to do another webinar next week.
Thank you so much for having me on. And again, happy to help the multifamily investor nation with any questions in this underwriting, topic.
Great. Well, we'll see you next week. And for those of you who have joined us right at the last minute or haven't taken the chance to, because you're paying attention to the webinar, haven't had a chance to register. I know several of you have already done that. Thank you so much for your confidence, and looking forward to being able to create some awesome networking time and opportunities. Even though it's virtual, we're gonna have lots of opportunities for networking. So stay tuned for those opportunities. But check out the mfinsummit.com. Use the promo code Danny, D-A-N-N-Y, and register for it to get $100 off. And then Danny also offered today to give you a quick deal analyzer that'll help you when you're doing a very, very initial underwriting of your deals, or deal and analyze to see if you're going to actually fully underwrite a deal. So thank you, everybody, for all of your questions. They were all very good and on point. And I'll send out an email to give you the link to this replay if you wanted to review it again. And I'll also, in that same email, send you a link to register for the part 2 in this series of underwriting strategies for these larger 100+ unit properties. So thank you guys for joining us, and we'll see you next week.